In this video, I'm going to show you how to calculate your monthly PITI payment. What is a PITI payment? That would be principal, interest, taxes, and insurance. So when you have a monthly payment from your lender, you're going to have more than just the basic mortgage. A mortgage is principal and interest. Principal is the actual nut, so to speak, of what you're paying down each month. That goes back in your pocket. Interest is how the lender makes money, and then you have property taxes and insurance costs. Typically, lenders are going to escrow that. And escrow is a big word that just means essentially collect money from you to pay it. And they're going to pay that for you. So we're going to calculate that and we're going to use this property as an example. So here I have 5206 East Walnut Street. This is a really cool house. This is in the Irvington neighborhood of Indianapolis. Um, Hardwoods, cute aesthetic colors, great first home. If you're interested in it, hit me up. Maybe it's still on the market. But anyways, it is still on the market for about 230,000, and we're going to calculate how much it would cost to own this monthly. And there's so many factors at play, what you're putting down and what loan product you're going to use, but we're going to go with a conventional loan. I'll talk about FHA loans and some other loans later, but we're going to go with the conventional loan, just kind of the cream of the crop basics. So first, you're going to search this website, mortgagecalculator.org, which is one of my favorite and most used websites. This is a mortgage calculator that's going to input, basic factors and spit you out what your mortgage PITI payment is. So let's just say you buy it at asking and it is $229,900. And let's say we're just using a 5% down conventional product. This is the most common amount down my first time buyers put. You're still putting some equity down, yet it's not an overwhelming amount. All right. Now for the interest rate, how do you know the interest rate? It's going to spit you out what it thinks the interest rate is. I usually like to say on Google, today's mortgage rates and see what it's saying. And I find it's just a little bit above. You can actually put it to your credit score. So let's say your credit score is really good. Well, you're going to get a better rate. Now, obviously, what you put down does affect it. So let's actually put it in, getting closer. All right. So the rate that it is spitting out is 6.61. That's a relatively good rate. I've had a lot of people about 1% higher lately. So let's put 6.61% in there. Loan term, typically we're doing a 30-year fixed. There is 15-year mortgages. Those are going to have a higher monthly payment, but let's just say it's a 30-year fixed. Property taxes. Now, a lot of times it's just going to put in there 1%. However, I like to be more accurate because sometimes there's special assessments and whatnot. So if you go down in Zenlist, which is the property search platform that I use here in Indy, it has a number, 774. Now, that number is a bit facetious. That is the semi-annual because there's a May assessment and then there's a November assessment. There's 2 times you pay taxes in Indiana per year. So we're going to actually put double that. And usually I'm putting in a little bit of a buffer because it could go up a little more. So we're going to say, we're going to say it's 1,700 a year. PMI. What is PMI? PMI stands for private mortgage insurance. So if you're putting less than 20% down on a loan, you have to pay a private mortgage insurance, which is essentially insurance the lender is collecting for the riskiness of the loan. If you're putting less down, they see you as more risky. Everyone has to pay it if you're under 20% down. It is not a crazy amount. I've seen it be as much or as little as $50 a month. So don't stress about PMI. A lot of people get all stressed about it. There is a PMI calculator. If you search PMI calculator NerdWallet, you will find it. I find this to be a really good way of calculating this. However, what's important to keep in mind is PMI is calculated based on your percentage down. So the less down, generally the higher. The loan size, your credit score is a huge factor in this, and the type of loan. However, For this loan, you could put in the home price. You put in this. How much down payment are we putting down? We're putting down 5%. I know it's a little bit more than what we're putting down, but your credit score, let's say we have a really good credit score above 740. Okay. It's telling me my PMI rate is 0.58. That means of the loan amount each year, I'm paying 0.58. And when you do the math, it adds up to 105 per month. Now, eventually PMI will kick off. So if you pay it long enough, it will kick off and go away. Or if you refinance and you now have 20% equity in the home, it will also kick off. But it's telling me it would last for 10.27 years. It also tells you what it thinks your entire monthly payment's going to be, which is kind of stealing my thunder, but um, that is an added benefit. So we're going to go back to our calculator and we're going to put in 0.58. When in doubt, you can just put 0.5 or 0.6. A lot converge on that. Now, homeowners insurance. Homeowners insurance is going to range from about $1,000 a year to $3,500 a year. $3,500 a year is going to be a massive house. So your your insurance premium is calculated based on the rebuild cost. So fire burns it down, tornado destroys the house. They're going to have to rebuild the entire house. Insurance will fund that. So the premium is kind of the riskiness, so to speak, of the lender and how much that's going to cost them. So for a smallish house like this one, which is about 1,300 square feet, it's going to probably run me about 1,300 a year for a premium because this house just wouldn't cost a ton to rebuild. If this house was double the size, it'd be about 2,600. So keep that in mind. And then we're using a conventional loan. And voila. All right. Our monthly payment is 1751.87. So that is all things included. Some people just look at principal and interest, but that is not the whole story. This would be your entire monthly payment. Now, if you're in a neighborhood, especially in the suburbs that has an HOA, you'd have to add that on. Now, what about FHA? Federal home loans are very common. So if you want to calculate the FHA monthly payment, go to FHA loan calculator on Google, and I find this one to be a really good one. And we'd put in the same things, and I am curious, so I'm going to go ahead and do that. Generally, we're at 3.5%, 30 years. You could search FHA interest rates and do the same thing. Let's say we're getting the exact same interest rate. The upfront FHA MIP or mortgage insurance premium, this is like another additional insurance because the federal government is insuring the loan that you have to pay. It does allow for the lower down payment and easier qualification. The annual FHA MIP is about 0.55 last time I checked. This one is usually 1.55. They both can be wrapped into the loan. Property taxes, we will go ahead and put in the amount that we had. Homeowners insurance, we're at 1,300. Other costs, we're not going to put in other costs. That'd be like maintenance and whatnot. Alrighty. This is telling me our monthly payment would be 1,445.61, which is interesting to me. I was expecting it to be more. However, it is telling me that it is less per month to use FHA. I'd have to dig into that a little bit more. I'm quite surprised because I would have thought these insurance costs would have made it more. So we could dig into that another day. But that is how to calculate the monthly payment for FHA loan. And you'd want to get clarity from your lender. Which loan product are they advising you to do? and it's probably coming down to the down payment and your credit score. In general, if you have a better credit score, they're going to put you down the conventional chute. If you have a loaded credit score, you're going to get better terms going with the FHA loan. Or if you only have around 3.5 to put down, they're probably going to put you again down the FHA chute. So don't be scared if they're putting you down the FHA chute. FHA is a great loan product. It's especially common with first time home buyers. Or even second, third time home buyers. It just depends on your particular situation. Now, the last thing I want to show you is a lot of people ask me, well, should I put 20% down? I kick off PMI. Well, I think it'd be worth running the numbers on this scenario. So let's increase this to 20% down. Your interest rate might actually be better with 20% down, but let's just say it's the same interest rate. 0 for PMI, conventional. Gonna give me a little ad here. All right, let's check this out. So 20% down with no PMI is 1425. So we're saving about $300 a month going from 5 to 20% down. Going from 5 to 20% down was thousands of dollars a month, and it's saving me $300 a month. Is that worth it? Depends on who you ask. You're going to pay a lot less interest in the life of the loan, and you're going to pay a lot less private mortgage insurance. So in the long run, it's probably worth it if you have that money. However, for people saving and saving years, I don't think 300 a month would be worth it to get in a home and start building equity versus renting. That at least would be my perspective on that matter. So there you have it. That is how to calculate your monthly PITI payment on a home. If you have any questions or you're looking for a home in Indianapolis, please reach out. Our team would be happy to help you. And best of luck out there.